Hey! Hi guys, this is Marcel Pechman. Welcome to Macro Markets. Today is Friday, March 10, and we'll be discussing the impact of the macroeconomic news and events on the crypto space. The best thing is, I'll explain everything in layman terms and focus on the cause and effect of the traditional finance impact on the day-to-day crypto trading activity. For today's show, I'd like to start by the stock market's main valuation metric, PE, or price to earnings ratio. So what's so special about this indicator? First of all, it works the same for any kind of company, sector, or the entire index, such as the S&P 500, as its only inputs are the estimates for earnings, profit, and the current stock price or the index price. So for instance, if IBM is trading at $120 and its earnings estimates it's $4, then you've got a price to earnings of 120 over $4, which is 30 times P price to earnings. That's the ratio of the IBM estimated earnings. So instead of the usual backward-looking metrics, one can easily find the earnings estimate for the most relevant companies and stocks and indexes. So this PE indicator can be used to measure the implied expectations. Yes, there are lots of PE charts or PE data they're gonna find on the internet that are either covering the previous year or the trailing the past 12 months. But it's pretty easy, pretty standard to find the forward price to earnings ratio, the estimates ratio. So it's not as backward looking as the other indexes. And the third reason why the PE ratio is so important is because it serves as a proxy to the internal rate of return, the same standard accounting measure we use for business and companies. So it calculates how many years it takes for these earnings to compensate the initial investment. So a PE ratio of 30 means you gotta collect the earnings for 30 years to compound your initial investments. So that's what the PE ratio is telling you. It works the same way for index and sectors. So if the forward PE ratio for the S&P 500 index is currently at 18, which is the actual number, March 2023, it means that an investor needs to wait 18 years collecting earnings to gather its initial investments on the S&P. So basically, the higher the PE ratio, the more costly the asset is. So a high PE ratio means the index or the stock is trading at a premium, at costly. Okay, so how can you use the PE indicator to guide you through your cryptocurrency investments? The idea is not so much trying to find areas that are deemed expensive or cheap on the stock market valuations. Instead, you should focus on avoiding periods where the PE expectations are either sideways or declining. So you should be monitor the S&P 500 PE estimate indicators, but not so much trying to find tops and bottoms. I'll show you a chart to show how you should be doing to analyze Bitcoin and cryptocurrencies. So this is a chart from Jargon Research showing the forward S&P 500 PE indicator. It's the red line. Notice how the indicator grows throughout 2016 and 2017, but it suddenly collapses in 2018 and the initial months of 2019. The recovery in the early 2020 after the COVID impact, for instance, was quickly, very quick. See how the S&P estimate goes down and recovers really quick. So it accelerates on the second half of 2020. So that mimics a lot what Bitcoin and cryptocurrencies have been doing. And if you notice here, in more recent years, in 2022 and 2023, It was a downhill or sideways until the beginning of 2023, when it recovered a little bit from 15 all the way to 18. So it mimics what the Bitcoin and cryptocurrencies are doing. Sometimes it lags for a couple weeks or months, or sometimes it's a leading indicator. It's going to tell you if there's a trend going for when investors are seeking risk assets. So if they're increasing estimates for the S&P 500, it's probably a good time to be buying Bitcoin and cryptocurrencies. My recommendation is that you trust the PE estimates chart more than the simple S&P 500 price index, because it encompasses earnings expectations, so it's a lot less backward looking. Now, on to the next topic of the show. We'll be discussing the Federal Reserve balance sheet. Well, it's a bit of a tricky subject, because the US Central Bank doesn't really own all that money that's deposited there. Most of it belongs to the US Treasury or the financial institutions that are required to maintain certain level of deposits due to capital requirement regulations. Regardless, the Federal Reserve holds and manages $8.3 trillion, yes, trillion dollars in its balance sheet. Most of it, it's sitting in US dollars, government bonds, gold, and foreign currencies. But some of it, it's a little bit shady, like the mortgage-backed securities, the MBS, the same instruments that turned into toxic debt into the 2008 housing crisis. So the market analysts and the media focus too much on the interest rate decisions from the Federal Reserve. But the power that yields from being able to expand or contract this trillion-dollar balance sheet is huge, is gigantic. And why should a cryptocurrency trader care about such chart or data? Well, if the Federal Reserve is selling assets, it creates an enormous pressure on risk assets, such as gold, stock, commodities, and cryptocurrencies. On the other hand, when the Federal Reserve goes shopping, so should you. We'll be checking a chart directly from the Federal Reserve website, showing the amount, the total consolidated amount on its balance sheet. Notice how the federal balance sheet expanded from $4.2 trillion in February 2020 to $7.2 trillion by June, just a few months later. Those who bought Bitcoin during that period got an average price of $8,300. By November, just 6 months later, it was already trading above $14K. On the other hand, the Federal Reserve balance sheet peaked at almost $9 trillion on March 2022 and has since then been declining every month, from the $9 trillion mark to the current $8.3 trillion. So those that started reducing their Bitcoin position and cryptocurrencies at the same time that the Federal Reserve did, made sales at $44,000, $40,000, $38,000, and so on. Okay, so let's go for a final recap. Number one, instead of using the S&P price chart, try using the forward PE chart as an estimate, because the indicator can decline even if the S&P 500 price stays the same. All it takes is worsening expectations. Number two, pay close attention to whether the Federal Reserve is increasing or decreasing its balance sheet. Data is published every week, so I suggest monitoring monthly trends. Well, that's it for today. Remember to like and subscribe to the new Cointelegraph Markets YouTube channel. We'll be airing every Friday at 12 o'clock noon Eastern Time, so I hope you guys enjoyed, and see you next Friday on Macro Markets.